Welcome, everyone, to our on-demand training covering understanding long-term care insurance for federal employees. On behalf of Serving Those Who Serve, welcome. Whether you're joining us for the first time or you are a returning member of our federal community, we're glad you're here. My name is Dan Sipe. I'm actually the founder of Serving Those Who Serve. And if you don't know us, we are a federal benefits education and fiduciary financial planning group with the unique mission to reach, teach, and serve you, the career civilian Fed. Now, I want to begin, as I always do, by saying thank you. Thank you for taking the time to be with us today, but also thank you for your service to the government, to the country, to me, to everyone. You do not hear that enough. You're always going to hear it here. I know you're watching this on your schedule, and that's great. That's exactly why we created this format. We recognize that the work environment for feds has changed radically over the last year, and finding time during your workday for professional, personal development has become increasingly challenging. So we made this valuable training available to you whenever and wherever works best, whether it's the evening hours, weekend time, or in segments throughout the day. You can watch a little bit, go away, come back. For this training, once again, we have the guru, Ed Zerndorfer, presenting. Ed is a retired career Fed himself and probably has more certifications than anybody we have ever encountered. He is also, hands down, the most published author currently writing about federal benefits. You have no doubt read his work in FedSoup, federalnewsradio.com, My Federal Retirement, Federal News Network, and perhaps most importantly for us in the Fed Zone. That's through our website, but you can find that at fed-zone.com. Quite simply, no one knows these topics better. Before we get started, I want to explain a little bit about the model for this because it's probably different from other on-demand trainings you may have encountered. So today is what we call part one, which is general education delivered in this on-demand format. But we also have part two, which is personalized education, which is delivered via Zoom at a time that works with your schedule. Why? Well, we've observed over the decades now that people will attend multiple webinars, seminars, lunch and learns, trainings, briefings, you name it, but still don't completely come away with a comfortable understanding of their benefits, how they'll behave, and how they will personally impact them and their families. So part two was created to ensure that you get your specific question answered and that you reach that deep and personalized understanding without pitches, pressure, or obligation. And that part is key. Because the part two is personalized to your situation, we offer it by appointment only. So throughout today's trainings, you'll see QR codes on most of the slides. If at any point you decide you'd like to schedule the part two, you can simply use the camera on your cell phone to scan that QR code, and this will open the scheduling page where you can pick a great date and time, what works best for you. Now, if you happen to be viewing this on your cell phone, and I can't imagine why you would for on demand because you can pretty much do that with it, but if you are, and obviously can't access the camera feature right now, just take a screenshot of any one of those slides, and you should be able to open the picture up in your Photos app, then tap and hold the QR code, and that should open the scheduling page. If for some reason it doesn't, or if you're just not a QR code person, that's perfectly fine. You can also email us directly at part2@swserve.com to request that session. We'll get you set right up. So here's how this on-demand session will generally work. Ed will present the comprehensive training content, and throughout the presentation, you'll see examples of questions that we typically address in our part two sessions. While you won't be able to ask questions in real time as you would in a live webinar, you can always email your specific questions to part2@swserve.com, or you can schedule a part two to take care of a whole bunch of questions at once where we'll address everything that's unique to your situation. Next, in keeping with our mission, in the interest of full disclosure, Raymond James asked us to provide the following slides, and we are happy to do so. What it's important I'd like to point out is that Serving Those Who Serve sponsors this educational session to bring Ed to you. Number two, Ed is not here to solicit, never. And this session, as all our sessions, will be purely educational. And lastly, we're not a part of OPM. I'll be back a little bit later to talk about the whole process, But without any further ado, let me introduce you to Ed in case you don't know him. He's been helping federal employees have a better understanding of their benefits and make better retirement decisions for over 25 years. Now, I told you he has a ton of certifications. Well, here they are. He is a certified financial planner, a chartered life underwriter, a chartered financial consultant, a certified employee benefits specialist, an enrolled agent, and like all of our advisors here at Serving Those Who Serve, is a chartered federal employee benefits consultant. Ed is also a member of the Maryland Society of Accountants, the National Association of Enrolled Agents, the International Society of Certified Employee Benefit Specialists, Financial Planning Association, the National Association of Health Underwriters, and the Society of Financial Service Professionals. I told you that he writes, boy, howdy does he, every single week for us right here in the Fed Zone. You can find that at fed-zone.com, as well as for My Federal Retirement. And he is my featured go-to guest on our FedLife podcasts. We do a couple of those every month. You can find those on YouTube. Incredibly informative, and I think you will enjoy them. So with that, let me turn it over to Ed, and we will kick off this on-demand trading. Take it away, sir. Ed, I think you're muted.
Hello, everyone. Thanks for joining us for this broadcast on long-term care. Dan mentioned that it's long-term care insurance. Yes, we will be talking about long-term care insurance, but we need to get an understanding of what long-term care is. Before we actually get started, I want to thank Dan and all the people at Serving Those Who Serve for once again giving me this opportunity to do not a live webinar. We do several live webinars, but this one we're doing on the broadcast. I couldn't do this broadcast as well as all the other live webinars we do without the full support of Dan and the people at Serving Those Who Serve. So I want to thank them. And again, I want to welcome everyone to this very important broadcast on understanding long-term care. Before we actually get started, I have some websites I like to refer to you. The first bullet there, www.ltcfeds.com. That's where you get specific information about the federal long-term care insurance program. The federal government has been offering a group sponsored, the sponsor, of course, is the federal government, a group sponsored long-term care insurance program. It's called the Federal Long-Term Care Insurance Program. It started about 24 years ago in 2002. It's open to federal employees and retirees, postal service employees and retirees, members of the uniformed services and retirees. I happen to be enrolled in it. My wife and I enrolled in the federal long-term insurance about 18 years ago in 2008. We're still in it. We're going to be talking about the program later on. First of all, how you enroll in it, and just give you some general comments about the program. All the information you need to know about the program is found at www.ltcfeds.com. The next bullet, www.fed-zone.com. As Dan mentioned, I write a weekly column for Serving Those Who Serve. It's called the Fed Zone. I write one column a week, every week of the month, every month of the year, on average about 50 to 60 columns on what topic? Employee benefits. I write columns on CSRS, on FERS, on Social Security, on many columns on the TSP, on all the employee insurance benefits, including the FEHB and Medicare, dental and vision insurance, life insurance, long-term care insurance. I write columns on tax planning for retirement. I write columns on survivor benefits, and I write columns on estate planning. You name it, I will write about it. I've been writing these columns on behalf of Serving Those Who Serve ever since April 2019, almost 7 years, and every column I've written in the Fed Zone has been archived. If you have a particular subject you'd like to read about, like FERS, like TSP, like long-term care, all you have to do is go to www.fed-zone.com, and under the search engine, put your favorite topic, and every column I've written over the past almost now 7 years will pop up. I want to emphasize the fact that the way I write my columns is so that you understand them. Nothing high-powered, down to earth, good information. A lot of your questions about your benefits can be answered just by reading my columns. Ladies and gentlemen, let's be very, very honest with one another. If you're an employee and you have questions about your benefits, and you go to your human resources office, you go to your personal office, those offices are overwhelmed They don't have time to answer questions. They've been cut back. Some of the questions you ask them, they cannot answer. They will not answer or shouldn't answer. Let me give you an example. You may have questions about the TSP. Which funds should you be investing in? How are your benefits when it comes to your retirement benefits? How are your retirement benefits taxed? They are not accountants. They're not insurance people. They can't answer questions about insurance. And again, you have a place where you can get those questions answered in the Fed Zone. And by the way, if you are a retiree, ditto. You have a place now also to get your questions answered. Because if you have questions, if you're a retiree and you have questions about your retirement benefits, don't call OPM. They don't answer questions, OPM, on the phone. If you have questions about TSB, don't call the TSB. They've been cut back to answer questions. And if you have questions about Social Security, they have really been cut back. It's almost impossible to get a hold of anybody at Social Security now. So please, you also, as a retiree, have a place to get the questions answered. www.fed-zone.com. Again, one column a week, every week of the month. It's out there every week. And finally, the last bullet there, www.stwserve.com. Among the things on that website, well, you can sign up for live webinars. We conduct on average about 4 to 5 live seminars each month. They're free. You can sign up as many times as you want. The more you attend, the more you're going to learn, more opportunities to ask questions. And when you've attained your first live webinar, you'll hear about the Part 2 process that Dan will talk about today later on, this Part 2 process. But again, this Part 2 process is a golden opportunity to have a serving those who are represented, to look over your retirement benefits, answer your questions. He'll talk more about that later. Also on the website there, www.stwserve.com, are blogs. Other serving those revenues write blogs on employee benefits on the website there. Well written. You can learn a lot by reading those blogs. They're there for your reading and enjoyment, information, help answer your questions. And finally, there are podcasts out there on the website. As Dan mentioned, he and I do a monthly podcast in which we review my recent Fed Zone columns. It's a question and answer session, runs about an hour and a half on various topics. There's over 100 podcasts out there that we have done over the years that you can listen to at your convenience, at your leisure, and learn a lot by listening to the podcasts. And other serving those representatives do podcasts with Dan. Ladies and gentlemen, my point is there is a tremendous amount of information on that www.stwserve.com website. We are here to help you answer your questions, to get through this challenge. It's been a very challenging time over the past year. It always is a challenge, but it's been especially challenging over the past year for federal employees and retirees. We're here to answer your questions. We are not here to sell. We're here to help. So please take advantage of all the great stuff that's on that website. All right, with that, let's go ahead and start talking about long-term care. Here are the questions that we're going to answer today. What is exactly long-term care? How does long-term care happen? Which individuals are affected most by long-term care? Which day-to-day activities are affected by long-term care? And this is a very important question, the next one. What is the distinction between acute care, subacute care, and long-term care? When you can answer that question, you are on your way to better understanding what long-term care exactly is and how to pay for it. What are the ways you can pay for it? Because it can be very expensive. What triggers a need for long-term care? Now, everyone seems to know about this thing called Medicaid, and they heard that Medicaid will pay for long-term care. Well, we're going to find out that yes, Medicaid is a way for paying for it, but it's not the best way to go. You don't want to depend on Medicaid to pay for your future long-term care needs. So those are the questions we're going to be answering today. All right, so let's go with the first question. What is long-term care? Let's read what it says here on the screen. Long-term care involves a variety of services designed to meet a person's health or personal care needs during a short or a long period of time. These services help people live as independently and safely as possible when they can no longer perform everyday activities on their own. Long-term care is provided in different places by different caregivers, depending on a person's needs. Most long-term care is provided at home by unpaid family members and friends. It can also be given in a facility, such as a nursing home or assisted living facility, or in the community, for example, an adult daycare center. The most common type of long-term care is personal care, help with everyday activities, also called activities of daily living, ADLs, activities of daily living. These activities, these ADLs, include bathing, dressing, grooming, using the toilet, eating, and moving around. For example, getting out of bed and into a chair. What this means is that something has happened during a person's life. Maybe they had a stroke. Maybe they had an accident. Maybe they have a particular disability. And they cannot do certain activities of daily living. They are candidates possibly for long-term care. Long-term care also includes community services such as meals, adult daycare, and transportation services. These services may be provided free or for a fee. People often need long-term care when they have a serious ongoing health condition or disability. The need for long-term care can arise suddenly, such as after a heart attack or a stroke. Most often, however, it develops gradually as people get older and frailer, as an illness or disability gets worse. Who needs long-term care? A lot of statistics out there when it comes to who are candidates for long-term care. It's difficult, however, to predict how much or what type of long-term care a person might need. Several things increase the risk of needing long-term care. One is age. As we get older, our risk for needing long-term care increases. We talked about, let's say, someone has a particular disease, like a disease like Parkinson. It progressively gets worse to the point they cannot take care of themselves, or a family member can't take care of them. They may not be able to live at home. They have to go to some type of facility. And that generally happens as a person gets older. Gender. Women are at a higher risk than men, primarily because they often live a little longer. Now that's changed the last few years. Women in the past were living much longer, but now the women are getting close. The men and women are getting pretty close in terms of their average life expectancy. Marital status. Single people are more likely than married people to need care from a paid provider. Lifestyle. Poor diet and exercise habits can increase a person's risk. Health and family history. These factors also affect risk. Now, let me just elaborate on that point. Just because a parent had dementia or Alzheimer's does not necessarily mean that a child's going to have it. If a family member, let's say a male, if there's heart disease that runs in the family, heart disease, heart attacks, strokes, a stroke can trigger a need for long-term care because it could result in mental incapacity. Dementia can run at that. So if there's heart disease runs in the family, particularly with a male, and one male member, and let's say the child has a father, has a brother who had a stroke, had a heart attack before age 60, there might be a chance that the son's going to have the same problem. Maybe not before age 60, but it could be later on. At that point, a stroke could trigger dementia, resulting in the need for long-term care. Long-term care, what is long-term care? What type of services are we talking about here when it comes to what long-term care is? Long-term care includes services that help people with daily activities when they can no longer manage on their own. This could be due to aging, illness, or disability. Care can be provided at home by family members or professional caregivers or in facilities like assisted living centers and nursing homes. This is a very interesting statistic. Around 70% of people who turn 65 today will need some form of long-term care at some point in their lives, often due to challenges with activities of daily living. What that's saying is that if someone lives to age 65, they have a 70% chance of eventually needing long-term care. Most people have a need for long-term care on average by the time they reach their late 70s or early 80s. It can happen earlier, though. Doesn't that? These are just average. These are statistics on the average. For some older people, the need for long-term care arises suddenly due to a health crisis. For example, it happens gradually as health declines with age, influenced by life expectancy trends. Key long-term care statistics in the United States. Long-term care is a vital part of the healthcare system, supporting millions of individuals across the U.S. Below is a breakdown of key statistics to help you better understand the scope of long-term care services, facility types, and demographic trends. Around 38% of people aged 65 to 69 were denied coverage in 2021 due to health issues, with the even higher rejection rates for those in their 70s. Now, what we're talking about denied coverage in terms of if they applied for long-term care insurance, they were denied. The U.S. has nearly 1 million licensed assisted living beds with an average of 33 beds per facility. More than 800,000 people reside in assisted living facilities nationwide. Of the $3.9 million receiving care in skilled nursing facilities, 78% stayed for 100 days or more. And this is a breakdown in terms of long-term care residents. This chart here breaks it down, their ages. You can see for yourself that most of the people there who are in long-term care facilities are over 85%. And the next largest group are those individuals who are in their mid-70s to mid-80s. And the gender breakdown, 67% of residents who reside in long-term care facilities are female, and 33% are male. All right. I have a question. I'm going to throw out here. Is this idea of this long-term care we just talked about, is it a new issue facing the American people? Have we just started talking about this in the last 10 years? No, it is not. It's been around. We talked more about it. We talked about long-term care has been an issue for decades. But it was only until, I would say, the late 80s, early 1990s that we started talking more about it. Now, some of the possible reasons why long-term care has received so much attention during the last 10 to 15 years is increased longevity. We're living longer now. More than 80% of individuals expected to live beyond age 65. And if they live beyond 65, we saw the statistic, there was a 70% chance they're going to eventually need long-term care. Social changes. Now, this is a big thing. I like to say in the good old days. I'm talking about way back when. Let's say in the 50s and the 60s, maybe early 70s. And we had children grew up with their parents, and then the children got married, and both sets of parents live in the same town. And when there was a need for long-term care, one of the in-laws needed long-term care, the children were there. They're living in the same town. Everybody lived in the same town, worked in the same town, lived in the same town. And when a parent or parent-in-law needed long-term care, the children were there to do it. Usually the female The daughter or daughter-in-law was there to do it. Why? Because the daughter and daughter-in-law, chances are, were not was working. It was a stay-at-home dad, stay-at-home mom, and was able, to take care of a sickly parent or in-law. Well, that's changed now. Things have changed. We don't all live in the same town. We have children who live in Washington, D.C., and one set of parents lives in Portland, Oregon. The other set of parents lives in Dallas, Texas. And mom cannot take time off, or the daughter and daughter-in-law cannot take time off because the daughter and daughter-in-law has to work herself. Cannot do that. So that's caused a need to think about the parents and parents-in-law have to think about how do we take care of our long-term care needs? Who's going to take care of us? Probably have to get professionals. So that's another. Social changes have caused us to think more about why we have to think about buying preparing for long-term care, buying long-term care insurance, or as we're going to discuss later on, perhaps self-insuring, setting aside money to pay for our future long-term care needs. And the next item is a very significant issue. There is a misunderstanding about Medicare and Medicaid. We talked about Medicaid a few months ago, that Medicaid is a federal government program in which the federal government gives out money to the states, and the states decide which of their residents are eligible for Medicaid. And Medicaid will pay for a stay in a nursing home, a so-called Medicaid facility, and you almost have to be impoverished in most cases to qualify for Medicaid. But we're going to get into Medicaid a little bit later in more detail here. But the point I want to make now is what I hear all the time. I've been a financial advisor now for 40 years, and when I talk to my clients about when they turn 65, and I recommend that they sign up for Medicare A and B. That's the Medicare A is the hospital insurance. Medicare Part B is medical insurance. And then I start talking about the paying for possible long-term care costs. The reaction is, well, why do I have to worry about it? Why have to worry about it? About paying for long-term care costs? And I said, I'm very frank. I said, because Medicare does not pay for long-term care. Medicare pays for health care in the sense acute care and subacute care. We're going to get to that definition here in a few moments. But Medicare will not pay for long-term care. They say, why not? Because long-term care is not considered to be acute care or subacute care. It's considered to be custodial care. And Medicare does not pay for it, nor will your health insurance. So you have to find another way for paying for possible long-term care. Medicaid is not one of them. And there's the issue now of the increasing cost of long-term care. I have some statistics here, how much long-term care is costing. Here we have this little slide here on the rising cost of long-term care in the United States. Long-term care expenses continue to increase across the U.S., making affordability a growing concern for families. Whether it's home care, assisted living care, or nursing facilities, costs have risen due to inflation, workforce shortages, and growing demand. This is according to Genworth's 2023 Cost of Care Survey. Here's the national median annual cost for different long-term care services. Homemaker services, median annual cost is almost $69,000. A home health care aide, this is a personal care, almost $75,500 per year. Assisted living facility, a private unit, $64,000 a year. Nursing home, semi-private room, $104,000 a year. This is per year. Nursing home, private room, almost $117,000 a year. Now that's talking about a year. The average stay in a nursing home is 3 to 5 years. Think about what were to happen if you had to go to a nursing home and you ended up being there for 5 years. You are, okay, in a semi-private room. That's over $500,000. And that's just you. If you're married and your spouse has to go, that's another half. It's over $1 million. Ask yourself the question, do you have money set aside to pay for long-term care? If you don't, perhaps think about buying long-term care insurance. We're going to talk about the different types of long-term care insurance, including the federal government, okay? Some long-term care demographics. The population of long-term care facilities is diverse, but aging and gender trends stand out. About 17% were younger than 65. 46.7% were between 65 and 84 years old, and 36% were 85 or older. All right, so let's now talk more about the need for long-term care. When someone has done their homework and now they know that, and they want to make sure that they're prepared to pay for the cost of long-term care, and they have the insurance policy. What we're going to be talking about is, how does that insurance policy kick in? How does it kick in? In other words, what is the specific need? When something happens to someone, how is the need for long-term care? How does that happen? There have been a lot of studies in the past about this, and it comes down to what's called two indicators of need. One, functional, that's physical. Two, cognitive, mental. Let's talk about functional. Activities of daily living, which we mentioned a few moments ago, ADLs. They include bathing, dressing, transferring meaning moving back and forth from a bed or a chair, continence, toileting, and eating. It says that if something happens to an individual, a stroke, a heart attack, they have some type of disability, they have Parkinson's disease, and as a result of having something that happened to them, they cannot do 2 out of 6 ADLs. They are a long-term care candidate. Now, the reason I'm saying this is because all long-term care insurance policies that are sold today, including the federal long-term care insurance program, are what is called qualified long-term care insurance policies. Why qualified? What is this business of qualified? The definition of a qualified long-term care insurance policy started when the Health Insurance Portability Accounting Act, HIPAA, HIPAA, was passed in 1996. That set the definition of what a qualified long-term care insurance policy is. Let me be a little more specific. Before HIPAA was passed, there was no such thing as a qualified long-term care insurance policy. With a qualified long-term care insurance policy that you buy, person owns this qualified long-term care insurance policy, and something happens to them, and they cannot do 2 out of the 6 ADLs. And a licensed health practitioner, a doctor, let's say a doctor who specializes especially in geriatrics, certifies that this person who cannot do 2 of these 286 ADLs, who owns this long-term care insurance policy, this doctor certifies that the condition is expected to last for at least 90 days. When the person or the person's family goes to the insurance company to offer that issued this long-term insurance policy. There's no arguments from the insurance company. I'm sure everybody listening today, I know I have, at some point during their life has had an argument with the insurance company in which the insurance company didn't want to pay out, whether it's auto insurance, whether it's home insurance, health insurance, the insurance company didn't want to pay out. Well, in this case, the insurance company cannot turn the claim down because it's in the doctor certified that the 2 out of 6 ADLs are, the person cannot do 2 out of the 6 ADLs, and the conditions is expected to last at least 90 days. The policy has to kick in with no going back. The insurance company, if they don't start paying out benefits, then they have violated the contract. So that's the functional. The other one's called cognitive, mental. If something happens with the visual, usually a stroke, and as a result of that, as a result of the stroke, they get dementia, or it can turn into Alzheimer's disease, and the condition of dementia or Alzheimer's expected to last at least 90 days. This person who has this dementia or Alzheimer's owns this qualified long-term care insurance policy. The policy has to kick in. The insurance company has to start paying out. One other thing about qualified long-term care insurance. Also, as a result of the HIPAA, a qualified long-term care insurance policy means that when the benefits are paid out, and what are we talking about? What are we talking about in terms of benefits? Well, a person has to go to a nursing home. They have to go to assisted living, or they're being taken care of at home. And the family is paying for that. They can get reimbursed for the cost of long-term care from the insurance company. And the benefits paid out are not taxable. The benefits, I repeat, are not taxable. So that's a very important part of a qualified long-term insurance policy. If you have to pay out, the family's going to pay out $117,000 a year for long-term care, and the insurance company is going to reimburse you the $117,000. Can you imagine if that $117,000 that you're getting is going to be taxable income? You don't want to think about that. I'm saying this because when after HIPAA became law, federal government says, we're going to leave it up to the states. We're going to leave it up to the states who license insurance companies to sell long-term care insurance in their state. Let them decide if they want to sell qualified policies or unqualified policies. The pitch for the unqualified policies was the fact that, number one, they're cheaper. To kick in, you may only have to do 1 out of the 6 ADLs, not 2. But here's the problem. With an unqualified policy, IRS says those benefits are going to be taxable. Well, I call the unscrupulous brokers and agents selling those policies, this goes back probably 10, 15 years ago, they're selling those policies, told the people they're selling the policies to, the policyholders, oh, the IRS wouldn't do that. How are they going to know? That's the usual. Yeah, how do you know? Ladies and gentlemen, I'm an accountant. And I'll tell you something. That's fraud. That's absolute fraud. Thank God, today, no unqualified long-term care insurance policies are sold. Every state has agreed that every policy sold in the state, and it's under the states to decide which companies can sell in their states, has to sell a qualified long-term care insurance policy. Now, there's one other possible indicator of the need for long-term care. And these are called instrumental activities of daily living, IADLs. I want to emphasize that IADLs, if someone cannot do a certain number of IADLs, it will not trigger a long-term care insurance policy. But it's an indication, though, that the individual may be on the road to not being able to do 2 out of 6 ADLs. And what are those IADLs? Choosing the appropriate clothes. They'll match. Using the telephone. Yeah, I know I'm old school. I still use the telephone. Still have a landline. Okay. Yeah, I do texting too. But this is serious. Older people, pin on the telephone. They pick up the phone. They don't know what to say. They forgot the word hello. They can't carry on a conversation. They're totally blank. They're just listening. They're not saying anything. Managing finances. Well, I don't think that has anything to do with age. I know young people. I know middle-aged people. I know close to retirement people who can't manage their finances. That doesn't mean they need IADL. They need to go. They need to go to a financial planner to get how to straighten out their finances. Also, this is interesting. So people forget to take their medications. Again, it's a matter of they're starting to forget, but that necessarily will not trigger a need for long-term care. I emphasize, not being able to IDLs is an indicator of a need for long-term care and services, but IADLs do not trigger a tax-qualified long-term insurance policy. It's only can't do 2 out of 6 ADLs. Okay. All right. So now, let's talk about, if you're going to buy long-term care insurance, what are some of the things you should be aware of? The long-term care insurance premiums, the premiums that you pay for long-term insurance are what is called entry age based. Meaning what? The younger you are when you buy long-term care insurance, the less expensive the insurance premiums. And note what I have in parentheses, at least initially. Long-term care insurance premiums are what they call guaranteed renewable. They're not level. They do not. They will go up over time. They will go up in cost over time. I say not level. If you buy what's called a level term life insurance policy, like I own a level term life insurance policy. I bought it when I was 59 years old. It's a 25-year level term. Meaning what? I pay the same premiums when I bought the policy at age 59. And as long as I pay the premiums each year, the same amount for 25 years, it'll be the same premiums. After 25 years, the policy's up. So with long-term care insurance, we're going to find out that premiums do go up over time. But you don't have to prove insurability from one year to the next. Once you're in, you're in. Once you're in, you're in. But the insurance company does have the right to raise premiums, and we'll explain how later on how that works, how they raise their premiums for long-term insurance. So what does that mean in terms of at what age should you buy long-term insurance? Younger people have a greater chance of qualifying for coverage because they have fewer medical problems. That's a fact of life. Is that a rule? Yeah, I would say. But here's the problem. When you buy a long-term care insurance policy when you're 25 years old, it'll be a heck of a lot cheaper compared to if you buy it when you were 65 years old. But here's the problem with that. When do most people have a need for long-term care? Remember I mentioned earlier when most people on average have a need for long-term care? Mid 70s to mid 80s. That's when they first have a need for long-term care. Think about the 25-year-old. When they buy that long-term care insurance by the age 25, they're going to be paying premiums for 50 years. The premiums are going to go up in the meantime, but they're going to be paying for 50 years. But they have it. That's a long time to pay premiums. And on the other hand, the 65-year-old, Yeah, the premiums are going to be much higher, and they only have to pay it for 10 years before, on average, they may have a need for it. But here's the problem. The 65-year-old, will they qualify? 65 years old. I know when I turned 65 years old, but 10 years ago, things started to get a little down. My health started going down a little bit, not too significant, thank God. But it's, I was not as active, or so to speak, or as I was when I was 55 and things 40. As you get older, you may develop you can develop some more health problems, which may negate your chances of getting it. So it's something, again, you got to think about when you're buying that policy. Most long-term care services are usually not needed until an individual reaches at least his or her mid to late 70s. But buying long insurance when one is young, before age 40, when premiums are cheaper, probably is not a good idea. I'm going to give you one exception, though. Let's give you one exception. I'm going to give you one exception to that. I'm going to give you an example of someone who was turned down for a long-term care insurance policy. Not the federal, it was with an individual insurance company. And here's how it goes. Person was 53 years old when she applied for this long-term care insurance policy. And on the application, it's going to ask questions about you, your current health. Just what medications you're taking, things like that. And one of the questions on that application is, long-term care insurance application is, are you diabetic? Are you a diabetic? It turned out the person is. She's taking type 2 insulin, and she was turned down. The rest of her health is okay, but she was taking insulin. The insurance company must have a record of people who are on insulin, have diabetes at some point, at some age, they're going to need for long-term care. They have the statistics. They turned her down. I had another individual who came to me. She was in her mid-40s, and she was applying for an individual long-term insurance policy. And she wanted to know what had to be done to buy this policy with this company. I was just here. I wasn't selling the policy. I was trying to give her some pointers. So I said, when you fill out the application, they're going to ask questions about your health. And she said, what type of questions? Well, are you on medications? Are you diabetic? And she said, well, stop right there. Diabetic. I am not diabetic, but it runs in my family. I have a parent who has diabetes. I have two siblings who have diabetes. I said, stop right there. You got nothing to worry about. She said to me, what do you mean I got nothing to worry about? You said, you mentioned that they're going to ask you about your health, and you said that if someone's diabetic, they'll probably get rejected for coverage. I said, I said that. But on the application for long-term care insurance, they're asking about your current health. When you put down that you don't have any ailments, you're not going to put down, I'm not diabetic, but I expect to be because it runs in the family. They're not going to do that. It's illegal for an insurance company to ask you questions when it comes to applying for long-term care insurance about family history. You are telling the truth when you say you do not have. You say when you say see the box, are you diabetic? You put no. You're telling the truth because you're currently not diabetic. They cannot start the fishing reservoir. Well, is there a history of diabetes in your family? I'll give you one type of insurance in which they can ask you about the heart disease. It's life insurance. Well, a life insurance application, especially if you're a male, they're going to ask you questions. If you're a male, is there a history of heart attacks and strokes of male members in your family, father, brothers? If they got heart attacks, or strokes before they reached age 60. In that case, the life insurance company is going to rate you or give you a not a good premium. You're not going to get a preferred rating. That is perfectly legal. Why? Because the insurance companies have a ton of statistics about males who died before age 60, how heart disease runs the family. So in this case here, my point I want to make is that if you know you're going to get something like diabetes or some other type of disease that runs in your family, and you know it's going to kick in at a certain age, get the long-term care insurance before that happens. What are some of the costs? We went to some of the costs involved with long-term care. It varies by region of the country and the type of care setting in which the care is given. Nursing home care is more expensive than assisted living care. So nursing home care, assisted living care is going to be more than home health care. Nursing home care is expensive in the Northeast, the far West, Alaska. It's cheaper in the Deep South. Same thing with assisted living care. Home health care is getting more expensive. Adult daycare is getting more expensive. Those vary around the region of the country. Average cost, in fact, I just want to mention about the pre-1990, this was before HIPAA, when long-term care insurance started in the middle 1980s, and those policies were only for what's called institutional care. What is institutional care? Nursing home and assisted living. There weren't that many assisted living facilities around in the 80s and early 90s. They started really in the late 90s. But that's called institutional care. Long-term care insurance policies sold before 1995 were strictly for what's called institutional care. Since then, all long-term insurance policies are sold include will pay for nursing home care, assisted living care, the institutional care, and non-institutional care, which includes home health care and adult daycare. Okay, here's the average cost of nursing home stay in the U.S. during 2024 is $110,000. That's $301 a day. Keep this figure in mind. That's $301 per day for a semi-private room. The annual cost of a home health care aid for services averaged $78,000 annually during 2024. As I said, long-term care insurance is a relatively new way of paying for long-term care. It's been around since the 1980s. Initially, as I said, it only paid for nursing home care and the few assisted living facilities back then, the institutional care. But then the Health Insurance Portability and Accountability Act, HIPAA, was passed in 1996, set the government standard for long-term care insurance policies. We talked about this business of tax qualified versus non-qualified. Okay. All right. Now, if someone's going to buy long-term care insurance, okay, it's very important that you ask some questions for the insurance company providing it. And here are the questions. These questions can help to make the most of a conversation. Or if you're buying it from a licensed insurance agent, or the agent will represent the company. First of all, that person has to have an insurance license to sell this and a special long-term care insurance license. I have an insurance license for health and life, but I'm not licensed to sell long-term care insurance. That's a special license that each state licenses people in their states to sell long-term care insurance. And here's some of the questions you need to ask. What services are covered? How much does the policy pay per day? Let's go back to here. Why did I do that? Excuse me 1 second here. I want to go back to the slide here. There's $301 per day. There's $301 per day. 1 second here. Here, there's $301 per day. If you want a long-term care insurance policy to reimburse you for your daily costs of being in a nursing home, let's say, you want a policy that's going to pay $301 a day, reimburse you $301 for the cost of care. Now that's $301 per day. But keep in mind, that long-term care costs are going up every year. So if you buy the policy when you are in your 50s or 60s, early 60s, and you won't have it, and you're going to have a need for long-term care insurance by the time you reach your middle 80s, you have to have some means of increasing the amount of your daily amount you're being reimbursed for. That daily amount that you initially choose has to be adjusted for inflation, and we'll show you how that's done as part of the policy. Okay. How long will the benefit last? Long-term care insurance policies, you have choices in terms of your benefit period. 2 years, 3 years, 5 years, 6 years. Lifetime benefits no longer exist. Insurance companies do not offer policies that will pay indefinitely. Does a policy ever expire? Is there a maximum lifetime benefit? Does the policy have a maximum length of coverage period for each service? In other words, is there a difference between how long it'll pay for nursing home care, assisted living care, home health care? Does this policy have a maximum length of coverage for what are the terms of the elimination period? Now, we're going to go through this in a few moments in terms of the breakdown of what you're choosing here. You're going to be, when you buy this long-term insurance, you have to make choices, specific choices about the benefits that are going to be paid out. And we're going to review these. I'm just going through the questions here that are part of the policies that you have to ask about if you're, when you buy this policy. Do I pay for the services out of pocket during the elimination period? We're going to go through how that elimination period works. Is there a buyout fee for the elimination period? How is a cognitive impairment such as Alzheimer's disease or another form of dementia covered? Does the policy require an assessment or physician referral prior to a hospital stay or other prerequisites for benefits to kick in? All right. The long-term care insurance market, I tell you, has really changed since it started in the 1980s. And right now, relatively few Americans, about 10% own long-term care insurance policies. And when I started this business in the 1980s, long-term care insurance was getting going then. And I can remember there were at that time a total of about 80 to 100 insurance companies that offered individual long-term care insurance policy. 40 years later, we are down to probably about 6 insurance companies that offer long-term care insurance to individuals. And one of the problems why so many of these insurance companies dropped out is that there's not much underwriting or actuarial experience in determining optimum premiums. Unlike life insurance, the insurance companies, when it comes to life insurance, they have it almost down to a science to determine how much an individual, when he or she buys life insurance policy, will pay for that life insurance. So, and as a result of that, many insurance companies that were offering long-term care insurance dropped out. It was a losing proposition. I'm not talking about small insurance companies. I'm talking about companies like Metropolitan Life Insurance Company, Northwestern Life Insurance Company. There was John Hancock Life Insurance Company, which runs the federal long-term insurance program. They no longer issue individual long-term insurance policy. The result is, with the 6 remaining companies that are offering individual, the insurance premiums have skyrocketed. They've gone up to the point that some individuals who bought policies from long-term care insurance companies, and another big one was Genworth, General Electric, GNWORTH. Many individuals bought long-term care insurance from Genworth, and Genworth got out of the business. Another insurance company took them over, raised the premium significantly. As a result, I know several individuals could not afford their premiums anymore, and they dropped the insurance. Okay, so again, it's not a big market. It's not a big market out there, and it's gotten very pricey. All right. So Dan, I have come to the point now. Take a look at questions here.
Yes, sir. All right, folks, we have these questions up here to kind of get your juices flowing. I'm sure you've been experiencing some questions as you've worked through the material so far. So I want to pause briefly here, share some examples we often hear at this point in the training. And these are exactly types of questions that we address in our part 2 sessions. Remember, you can scan the QR code on any slide to schedule your part 2, or you can email us at part2@stwserve.com. But what I'd like to do right now is tell you a little bit more about the part 2 process. So you have a little better understanding of it, since we've mentioned it a couple of times now. So part 2 came as a result of our observation over the years here at Serving Those Who Serve, is that people come into trainings like this with questions like, what is it? How does it work? Well, then the information starts flowing, as it is done so well today with Ed. And pretty soon those questions morph into, what's mine going to look like, and how is that going to affect me and my family? And that is exactly why we created part 2. So part 2 is what we call personalized education, and the focus is on education. It consists of 2 complimentary, no obligation meetings with one of the advisors from Serving Those Who Serve to review your benefits. So today we're learning about long-term care, which is an important thing to consider in retirement. But we also believe that no retirement decision exists in a vacuum. All of the parts can influence your retirement. So we are going to discuss everything. And to do so, we're going to create a comprehensive report covering all of your retirement benefits. Now, the first meeting is data gathering. We're going to ask you to bring some information. Then at that second meeting, we're going to review with you in detail that benefits report. So obviously, we're going to do some pension projections, but we'll also talk about Social Security, TSP, Federal Employee Group Life Insurance, health insurance, Medicare, survivor benefits, of course, long-term care, all included in the report. What I'd like to do here, though, is a little compare and contrast between the report that you're used to from your HR and the one that we provide. Those HR reports are fantastic, incredibly accurate. But one of the biggest shortfalls that I've noticed across all the chassis is they only show the first year of retirement. You are going to be retired for longer than 1 year. So by contrast, our report goes much further. And at age 95, or actually age 90 to be precise, and we'll give you multiple scenarios for different retirement dates as we project out of a longer term what your retirement might look like. In addition, with regards to Social Security, the HR reports many times will give you a summary. And yes, you can always log into SSA.gov to track down more information. But our report is going to bring Social Security and your pension together and also show you what future cost of living adjustments. And that is really important. So to sum it all up, we'll cover FERS retirement and your pension, survivor benefits, FEGLI, health insurance, TSP. Oh, we talk a lot about TSP, especially this year with the Roth conversion options. Traditional TSP, Roth TSP, Roth conversions. What's the best way to get money out of TSP? Long-term care. Those are all the things that we can talk about in these meetings. And again, there's no obligation. So Ed and I encourage people to take advantage of this. We've never met anybody who didn't learn something from a part 2. And best of all, the meetings are held over Zoom, so you don't even need to go anywhere. So you can schedule them at times that work with your calendar, wherever it fits throughout the day. So to schedule your part 2 session, simply scan the QR code you see on one of the slides or email us at part2@stwserve.com, and then we'll send you a calendar link so you can choose day and time that works best for you. And now, Ed, back to you, sir.
Thanks, Dan. Okay, so we were talking about buying a long-term care insurance policy. Let's get more specific in terms of once you have the policy, how, and then in terms of how the policy will kick in. Okay, just as a review here, to buy a long-term care insurance policy, you fill out an application and answer health questions. The insurance company may ask to see medical records and interview you by phone or face to face. And the reason they do that is because they have to make sure that you are a mental capacity So they're going to ask some basic questions. They make a home visit. They want to see, if you live alone, the condition of your place. Is it clean? Things like that. They're going to just an assessment of your whole well-being, as well as where you live. When you fill out the application, you have to choose the amount of coverage you want, and we'll get into specific there what you're choosing here in a few moments. The policy usually caps the amount paid out per day. That's how I was giving the example that the average cost per day or annually in this country is about $301 per day, and you want to make sure that you have enough. You're being reimbursed enough for your policy. That's for given the cost of your care. It's $301 per day that you choose to have a daily benefit paid out from the insurance company of $301. Okay. Once you're approved for coverage and the policy is issued, you begin paying premiums. Once again, a long-term care insurance policy, like a life insurance policy, is a bilateral contract. You, as the insured, only have one obligation: pay the premiums. The insurance company has the obligation that if you need the benefits, the insurance company will start paying them out. Under most long-term care insurance policy, you're eligible for benefits when you can't do at least 2 out of the 6 activities of daily living, called ADLs. Once again, that's certified. The condition is it's going to last for at least 90 days, as certified by a doctor. Or you suffer from dementia or other cognitive impairment. And again, that condition would last for at least 90 days. Here are, the list of the activities of daily living. Okay. When you need care and want to make a claim, the insurance company will review medical documents from your doctor and may send a nurse to do an evaluation. Before approving a claim, the insurance company must approve your plan of care. Under most policies, you'll have to pay for long-term care insurance services out of pocket for a certain amount of time, such as 30, 60, or 90 days before the insurance company starts reimbursing you for any care. This is called the elimination period. What happens during the elimination period? The insurance company is not paying anything. You are paying out of pocket for any possible long-term care. All right, so let's get into specific here about the choices you make when it comes to buying this long-term care insurance policy. First choice is your elimination period or waiting period. That's the amount of time in which you will pay out of pocket for your long-term care. The shorter the elimination period, the more expensive your insurance premiums. You could choose a 0-day elimination period with some insurance companies. 0 day. That means that the insurance company pays out starting from day one. But it's going to cost a lot more. That policy will cost more in premiums to you compared to if you chose, let's say, a 360-day elimination period, a whole year before the policy kicks in. Okay? Let's go over that definition again. The elimination period is the number of calendar days during which the insured is eligible for benefits before the insurance company reimburses for long-term care expenses. The long-term care insurance company does not pay benefits during the waiting period. The waiting period has to be met only once. And what that means is that if an individual has purchased this long-term care insurance policy, and let's say they have a 90-day waiting period. If it turns out during their lifetime they have a multiple need for long-term care. They have a multiple need for long-term care. Different instances in which they needed long-term care. They only have to meet that waiting period one time. And once they meet the waiting period, then if the given instance, if something happened to them at the point they needed long-term care, and they met that waiting period for that first need for long-term care, then every need for long-term care in the future, they don't have to meet the waiting period. They met it the one time. Now, elimination period. Here's some of the questions you need to ask the insurance company or the agent selling or that's arranging you to help you, to help you purchase the policy, filling out the policy. You have to make this choice. You have to make this choice of what your elimination period is going to be. I will tell you that with the federal long-term care insurance, there's only one waiting period, 90 days. That's the only one, 90 days. So if you buy, let's say, you want to try the individual market, and let's say the agent or broker, long-term care insurance agent, long-term care broker comes, to sit down with you, you have to ask the questions. How are the days counted towards the elimination period? And are the days cumulative? In other words, back to my example. Suppose you had some individual has a 90-day waiting period. And it turned out the person had a stroke. And it turned out that they had a 90-day waiting period, and for the first 40 days of the time after they had stroke, they were being treated for the stroke in the hospital, maybe a skilled nursing facility, in which they were not getting custodial care. They're in the hospital. They're in a skilled nursing facility. They're getting what's called acute care in the hospital or subacute care in a skilled nursing facility, in which long-term care insurance does not pay for that. What insurance pays for you go to the hospital or skilled nursing facility? Health insurance. If you're over 65, you're enrolled in Medicare Part A. And your health insurance. So let's say you have the federal employee health insurance as your secondary. Maybe you have TRICARE. You're TRICARE for life. You're a military retiree. You have to have Medicare Part A when you're and Medicare Part B when you are enrolled at TRICARE for life. TRICARE for life is free, but the point is that skilled care is being paid for by Medicare and by Medicare A and B and your health insurance, the FEHB plan, TRICARE for life. Here's the thing you got to keep in mind, though, that even though you are you're in the hospital, you're in a skilled nursing facility, those days, in my example here, you're 40 days in the hospital in a skilled nursing, they will count towards your 90-day waiting period. Even though after you get out of the hospital, skilled nursing facility, you're okay. You don't have any need for long-term care. It still counts towards the elimination period. The point I want to make here is very important. That you don't need to buy a long-term care insurance policy that has a 0-day waiting period. It's a waste of money. Why? Because someone does not wake up in the morning and say, "Oh, I feel terrible. I need some long-term care." It doesn't work that way. It does not work that way. Something is going to trigger a need for long-term care. My example again, a heart attack, a stroke, in which they're going to go to the hospital. They're going to go to maybe to a skilled nursing facility, maybe rehabilitation. And health insurance and Medicare pay for that. And it still counts towards the waiting. It counts towards the wait at that 90, the waiting period, whatever it is. So my example here, 40 days, person gets out to the skilled nursing facility. Then 3 years later, same thing happens. And then they end up in the hospital skilled nursing facility. And for 60 days, well, guess what? Now we're up to 100 days. They met the waiting period. And if at that point they got to go to a nursing home because health insurance, I'm sorry, the hospital can't do any more for the person, they go to a nursing home, then the policy will kick in from right away. Immediately, from day one. Is there a separate elimination period for home health care and for institutional care? That used to be the case. Now, the elimination period applies to both. So if you have multiple episodes, some in a nursing home, some in an assisted living facility, some and then you have to go home, and you have nurses coming to your house taking care of you. That's also acute care. Then Medicare Part A also pays for that. Some home health care that will count towards the elimination period. Now, I'm going to make a real life example here, how this works. And the point of my example here is to inform you how well the nursing homes know exactly who pays for what and for how long. And the example goes as follows. This is a personal example. Now, 30 years ago, my father had a stroke. And it was just a guy, I just have to preface this by saying that my parents had Medicare, both for Medicare A and B, and they had health insurance, but no long-term care insurance. So after he had his stroke, he went to the hospital and he was put in intensive care. And after a few days, after about a week, week to 10 days, something like that, he got better, but at that point, he had to go to rehabilitation. Now, the way that works in hospitals, I know back then it is, and I think it's probably the same thing today, that if you go to rehabilitation, you're coming out of intensive care, then you go to your room, and then they're gonna put you into rehabilitation, and this may take a few days, may take weeks. But the point is, if you don't show progress in rehabilitation, the hospital's going to kick you out. So that's exactly what happened to my father. After being in the hospital for about a month. Hospital called me in because my mother at that time was not in good shape either. She had started to have signs of dementia. So I was really the spokesperson for the family. Here's what the hospital said to me. It says, Mr. Zerndorfer, your father is not showing any progress. He cannot stay in the hospital anymore. I said, what am I supposed to do? Well, he has to go home. I said, hey, he can't go home. My mother can't take care of him. So what's the alternative? They said, well, we'll have to go to a nursing home. There's one right across the street. That's the only choice you have. All right. So he went across the street to the nursing home, got there, and had to go to the bursar's office to make arrangements for him to be there. So here's what the bursar's office said to me. He said, Mr. Zerndorfer, we know your father his has health insurance, has Medicare Part A and Part B, but no long-term care insurance. We also know that he is 30 days into Medicare Part A. So what we're going to do is we're going to put him downstairs. This is the nursing home in our quote unquote skilled nursing facility. Why do they say that? Because who pays for skilled nursing? Who pays for skilled nursing facility care? Medicare Part A. And whatever Medicare Part A doesn't pay, his health insurance will pick up the difference. Medicare Part A will only pay up to 100 days. Remember, he has 30 days already in this one incident. So this is what he has 30 days. This is per incident. Up to 5, I think it's up to 6 times a year. It has to be at least a 5-day interlude between each incident. Well, this is his one incident. He has 30 days. So they're only gonna pay up to 70 more days. That's your health insurance. That's the health insurance and Medicare Part A. And after 70 days, we will bring him upstairs and put him into our long-term care facility. But to do so, you are going to have to put up $50,000 of assets. I said, they don't have that kind of money. They don't have to apply for Medicaid. We are a Medicaid facility. I've heard horror stories about Medicaid. I said, well, you got no choice. Well, I'll tell you this. This so-called skilled nursing facility was negligent. Within a few days of him being put down into the skilled nursing facility, he developed pneumonia. He died 3 days later. End of story. But I'll be honest with you. I don't know what I would have done had he lived. I don't know I can't take their house and sell it because my mother's still living there. So I want to make a point here that the hospitals, the skilled nursing facilities, nursing homes, they know everything about who pays for what and how for how long. It's very important that you understand what's going on here when you buy this long-term care insurance policy. I'm just going through one aspect now. We're going to get to the other parts of which you're applying for next. All right, the daily benefit amount. DBA. What is the DBA? It's the amount, the dollar amount that the insurance company will reimburse you, the insured, for your long-term care costs on a daily basis. It's the maximum amount that the long-term insurance will pay or reimburse for any day in which long-term care is required. Now, I've seen a lot of choices here from private policies. I'm anywhere from $50 a day all the way up to maybe $500 a day. The Federal Long-Term Care Insurance Program, FLTCIP, you can choose anywhere from $100 per day all the way up to $450 per day in $50 increments. The higher the DBA, the higher is going to be your premium. What are some of the questions related to DBA? What is the cost of long-term care in your area? I will tell you that the cost of long-term care in the Washington, D.C. area or the Northeast, New York, Boston, Midwest, Chicago, Minnesota, Far West, California, Oregon, and Washington is a heck of a lot more expensive compared to the cost of long-term care in Tupelo, Mississippi, or Fayetteville, Arkansas. So if you're living in an area now, let's say you are in a cheaper area of the country, Where are you going to be? Where are you going to be in retirement? Or are you going to be in maybe you're living in a little more expensive area of the country? You got to think. You can't think now. You got to think ahead. Where are you going to be living? In the area that you're going to be retired and you most likely have a need for long-term care. Will you be overseas? Keep in mind that the federal long-term care insurance program offers long-term care benefits for federal employees and retirees who move overseas. Yes, you'll get reimbursed for your cost of long-term care overseas. But the cost overseas can be expensive. I know in Europe's expensive. So you got to be prepared. Or maybe you want to go to a cheaper area of the world. Maybe, who knows? There are cheaper areas of the world to retire to. Another factor here in terms of your DBA, how about this idea of self-insurance? Self-insuring. Instead of buying a high DBA, let's say you're thinking about, well, maybe I'm really worried what my long-term care costs are going to be come when I'm in my early 80s, or I'm going to be living. Maybe I should get that, I want to get the federal long-term care insurance and I'll go for the $450 per day. That's the maximum I can get. Yeah. I think that would be a good idea. Well, when you see the premium of $450 a day, you're going to fall off your seat. So here's something you could think about doing. Instead of getting the $450 per day, get maybe $300 per day, and with the other $150 per day, self-insure. We're going to talk about a little bit later. What are some ways that you can self-insure? Setting aside the money yourself to pay for possible long-term care. Keep in mind that if you buy this expensive long-term care insurance policy, the $450 per day, and you die before you ever get to a nursing home, all those premiums you paid are lost. You lose them. Whereas when you self-insure, that money you set aside for possible long care is your money. You die, who gets it? It's, you have a beneficiary, like, or you put it in your will. Who gets that money into your account? Should you be concerned about home health care? Answer is yes, you should. And you don't think that home health care is that much cheaper than nursing. The home health care has gotten much more expensive ever since COVID. Okay. Next item, benefit period. That is the period of time that the insurance company, will reimburse or pay indemnified DVA. The longer the benefit period, the higher the premium. The federal long-term care insurance program offers 4 choices as far as your benefit period. 2 years, 3 years, 5 years, or 6 years. Questions. What considerations go into choosing a benefit period? Well, your family health history. Dementia, or is there dementia? Is there Alzheimer's in your family? The reason I'm saying it is that the average stay in a nursing home is 3 to 5 years. And that's for individuals who have this functional, can't do the 2 out of 6 ADLs, they have physical problems. Whereas individuals who have dementia or Alzheimer's, they have chances are they're going to live longer than that. I've seen my mother, once she was diagnosed with dementia, turned to Alzheimer's, she lived 8 years. They can live longer. So that's something you need to consider. Now, I have to explain put this all together here, how this actually works. Okay. We talked about the elimination period, we talked about the daily benefit amount, and we talked about the benefit period. What the insurance company does with this long-term care insurance policy is that the insurance policy owner has selected a so-called pot of money. It's a pot of money. When you multiply the DBA times your benefit period, that will result in a pot of money. Let's do an example here. Suppose you have a DBA of $100 per day and a benefit period of 3 years. That's 1,095 days. So the pot of money, this is called the maximum lifetime benefit, is $100 per day times 1,095 days, that's 3 years, is $109,500. So what that means is the following. That pot of money actually could last longer than 3 years. Let me give you an example. Suppose somebody has a need for home health care, and it's costing, the actual cost of the home health care is $80 a day. It's maybe the home health care aide is only coming maybe, let's say, for 12 hours a day, not 24 hours a day. So how much will the insurance company reimburse the policy owner? $80 a day, because that's the cost, $80 a day. And if that continues like that, understand that the pot of money is going to last for more than 3 years, because the maximum paid out per day is $100 a day, and the insurance company is only paying out $80 a day. So the pot of money is going to last more than 3 years. However, if the actual cost of a long-term care is going to be $120 per day, suppose the person needs home health care aid for 24 hours. It's costing $120 per day. They're only going to get reimbursed $100 per day. They're not going to get more than $100 a day. And therefore, under those circumstances, the pot of money is only going to last for 3 years. 3 years. The old policies, and I know this used to be the federal long-term care insurance, offered a lifetime benefit period. Lifetime. Meaning that the pot of money is unlimited. Those policies no longer exist. But even then, you're restricted to the amount per day. It would pay forever, but not more per day than what you specified. Another factor here you got to keep in mind, this is another choice, okay, is that when you choose your DBA, let's say you buy that policy when you are in your early 50s, mid 50s, maybe up to like 60, and you know that you're not going to need this policy for 20 years, and you choose, let's say, $200 per day daily benefit amount. You've done your homework. That's going to be enough. Well, you came up with $200 per day, and that's current dollars. With inflation the way it is, how much will the long-term care cost 25, 30 years from now? It's going to be eroded. I mean, when it comes to medical inflation, today inflation is bad. You go to the supermarket, things have cost of everything seems to be up. But medical inflation is far worse. Look at the cost of your health insurance, how it's going up. Medical care. Post-COVID, healthcare costs are going up 10 to 15%. Just read an article now. It's got health insurance premiums have gone up so much in the private world that some people can't afford it. What they're paying for health insurance per month is rivaling what they're paying for their house, for their mortgage expenses. So is there any way that your daily benefit amount can keep up with inflation? The answer is yes. You choose an inflation factor. Compound, and it's going to be a compound. It's called compound inflation. Every year it goes up by a certain percentage. Like if you choose a daily benefit amount, like I said, $200, and you're using compound inflation. So that means the first year you have this policy, if you needed benefits, you would be reimbursed $200 per day. But the second year, that $200 per day would go up by 3%. Now you're up to $206 per day. You're not taking money out of the policy. The policy is it's gaining inflation. It's being increased automatically from one year to the next. And then come the third year, we're going to take another 3%. It's up to $212.19. Now, I will tell you that the inflation costs the inflation factor choice can really drive up the cost of the policy. It can really be significant. And getting this inflation protection is very important if you buy this policy before 65, because if you don't, you're not keeping up with the true cost of long-term care insurance. At the same time, if you're going to buy it after age 65, I recommend you do not get inflation. Instead, choose a higher DBA. Start off with choose a higher DBA and do some self-insuring to make up the difference. Other features of a good long-term insurance policy: you're admitted to any level of care. The premiums are guaranteed renewable. Waiver of premium. What is that all about? This is very important. Very important. You buy this long-term care insurance policy. You got, for example, $200 per day, 3% inflation, 5-year benefit period. And you start paying premiums. You bought this policy, let's say, when you were 60. 15 years later, you go to a nursing home. You start using this policy. At that point, when you are getting the benefits of the policy, you enter a nursing home, you're admitted, the insurance policy is paying out, you stop paying the premiums. It's called a waiver of premium. When you start getting the benefits of a long-term care insurance policy, you stop paying the premiums. Now, could you think of any insurance that is that way? Any insurance that's that way? Is your health insurance the same way? Here you have the federal employee health insurance. And you go to the doctor. You go to the hospital. Do you still have to pay the premiums? Yes, you do. But long-term care insurance, when you start getting the benefits, you stop paying the premium. The old policies, when there was a lot more insurance companies out there, which they're not today, like I said, only 6 companies. Some companies would give you a healthy discount. If you're in better health, they give you a discount. Not anymore, those policies. And there used to be some private companies, never the federal, that if both spouses applied, there was a discount. It was called spousal discount. Not anymore. And the federal never had that. Most long-term care insurance policies now will give you what's called a care advisory benefit. When you need the benefits, your family can talk to someone and give you advice, from the insurance company that will give you information about choosing a nursing home, choosing assisted living. And there's also a bed reservation benefit with most long-term insurance policies. And what that means is that if you buy this policy, this long-term care insurance policy or a private policy, and you have to go to a hospital, you're in a nursing home, but then you have to go to the hospital. The nursing home doesn't have unlimited beds. That you're guaranteed that when you get out of the hospital, you go back to your bed. Called a bed reservation benefit. All right. So let's talk about some of the tax issues related to long-term insurance. The tax treatment for long-term care insurance generally is the same as for major medical insurance. And what that means is that the premiums you pay for long-term care insurance are considered to be qualified medical expenses. Can you deduct those premiums? In general, if you want to deduct medical and dental expenses on your federal income tax return, number one, the federal income taxes return, number one, you have to itemize. You have to file Schedule A. And one of the itemized deductions is medical expenses. That is, includes medical and dental expenses. The premiums you pay for long-term care insurance will be included as part of your medical expenses. But keep the following fact in mind. If you want to deduct your out-of-pocket medical and dental expenses, on Schedule A, the total of your out-of-pocket medical and dental expenses have to exceed 7.5% of your adjusted gross income. So if your adjusted gross income is $100,000, your out-of-pocket medical and dental expenses, which includes long-term care insurance premiums and long-term care expenses, have to exceed $7,500 before you can start including anything above $7,500 as part of your medical expenses. Once again, benefits from tax-qualified insurance policies generally are not taxable. Okay? A long-term care insurance expenses cannot be reimbursed through a healthcare flexible spending account. For those of you who are employees in the federal government, we have what's called a healthcare flexible spending account, a healthcare FSA, in which you get reimbursed on a pre-tax basis for any out-of-pocket medical, dental, vision expenses. But premiums, long-term care insurance premiums, in general, premiums can never be reimbursed through a healthcare FSA. But we're talking about out-of-pocket medical, dental expenses like deductibles, co-payments, co-insurance. They can be reimbursed through a healthcare FSA, but long-term care expenses cannot be reimbursed through a healthcare FSA. Note the last bullet there. Withdrawals can be made tax-free from a health savings account to reimburse the premium costs of a tax-qualified long-term insurance policy. Now, what that means is if you own a health savings account, an HSA, through the years, you have contributed to an HSA. In order to contribute to an HSA, number one, you have to be under age 65. Number two is you have to be enrolled in what's called a high deductible health insurance plan, HDHP, high deductible health insurance plan. And associated with a high deductible health insurance plan, the federal long-term care insurance program has several high deductible health insurance plans, is what's called an HSA, in which you put money into your HSA on a pre-tax basis. Money in the HSA grows. It can be invested like an IRA, get interest, dividends, and all qualified withdrawals from the HSA. Qualified withdrawals, withdrawals for your HSA are used to pay for qualifying medical, dental expenses are tax-free. So the HSA has three tax benefits: tax deductible in terms of contributions, 2, tax-free growth, and 3, tax-free withdrawals. And one of the things you can do with your HSA, take money out of it, is to reimburse you. Again, money's coming out of your HSA tax-free to reimburse you for your long-term care insurance premiums. Here it is, 7.5%. Now, 7.5% is that key thing here in terms of being able to deduct the premiums for our long-term care insurance policy, as well as in any other medical expenses. A Form 1099 LTC is used by the insurance company to report reimbursement for long-term care expenses. I said earlier that if you own a long-term care insurance policy, and then you have a need for the long-term care insurance, and then you've got to go to nursing home, assisted living facility, and the insurance company is reimbursing you or your family for the costs of the nursing home, costs of the assisted living facility. The insurance company will issue, in the January after the year you get these benefits, a 1099 LTC showing the benefits paid out by the insurance company. Now, what does that 1099 LTC do? What is it for? It's an informational piece. The insurance company has to tell the IRS that they have a policyholder who is getting benefits from this long-term insurance policy and showing the total amount of benefits. I have somebody across the street. He owns the federal long-term care insurance policy. He's had a need for long-term care for almost 2 years now. It's done at home. He has care coming in. The federal long-term care insurance program sends a 1099 LTC. They've been doing it for the last year, and they're going to do it very shortly for the last year, to his wife. And his wife said to me, "Do I have to report this on my tax return?" I said, No. It's for informational purposes. Does the IRS get a copy? He said, yes. Well, why do they give this to me? Well, IRS gets a copy of this. And in case you get audited, and you got to show this on your tax return, what the benefits being paid out. Is it going to be taxable income? No, it's not going to be taxable income. Hopefully you bring this to your accountant, prepares return, will show it. So again, I don't understand. Why does it have to be, why is it being done for informational purposes? And in case you get audited, I don't know, there's too many audits going on these days. The IRS revenue agent will say to you, listen, I notice your number, $120,000 of benefits was paid out to this policy. It's not taxable income. It's not going to show up as taxable income. The revenue agent said, I'd like to have proof that the money paid out from the insurance company was for the care. Show me the bills you got from your long-term care health provider, because they use a service, that you used that money, the money was paid out. Give me all the bills so I can add it up here to make sure that all the money that paid by the insurance company was used to reimburse you for the care. As far as how much of the premiums, the long-term care insurance premiums can be deducted, every year the IRS sets a limit. And it's by age bracket. Let's read what it says here. If someone owns, like myself, someone owns a long-term care insurance policy, okay? Long-term care insurance policy. Depending on their age, will tell you, and they itemize, will determine the amount in this year that they can include as medical expenses. So the long-term care insurance policy owner is on 40, up to $500 can be added to their medical expenses. That was up from $480 for 2025. If they're between 40 and 60, it's $930, another $30 from last year. And so on. I'm over 70, so is my wife. So each of us can include up to $6,200 on our as medical expenses. It turns out we take the standard deduction, so it doesn't make any difference. Our standard deduction is much more than our itemized. Okay, here's some additional questions you may want to think about. And again,
absolutely.
That if you have these are the type of questions you bring up during a part 2 meeting, as Dan was talking about. And again, you may have other questions, but again, this is what the purpose of part 2 is.
Absolutely. And folks, before Ed continues with the presentation, I want to share something with you. But first, I want to say thank you. Why? One of the things that we understand is that many of you found out about this training because a friend or colleague told you about us. And that is incredibly important to our mission, and we would like you to join us in that. Why? It helps us provide these types of trainings at no cost and allows federal employees to access them whenever they need it. So by sharing the training with others, you're helping us get the word out, and you're helping your friends get a better understanding of their benefits. Ed's mentioned it, and at SWS, we know it. HR and retirement specialists are stretched really thin and just can't provide this type of comprehensive education for every employee. So I'm asking you for your help. And what I'd like you to do is think right now of a person who should be watching this training and then let them know about it. So it's pretty easy to do. Just feel free to forward the link that you used to view this to the training, or just send them directly to swserve.com, where they can access all of our on-demand training and other resources. We're asking each person to reach just one person. So each one, reach one. Thank you for helping us spread the word about this valuable resource for federal employees. You are now part of the mission, and we thank you for that. And now, Ed, let's go back to you for the final section.
Let's continue where we left off, talking about buying long-term care insurance. Well, we're going to take a slight diversion here. I mentioned this earlier about self-insuring. One of the problems there are two problems I find now with long-term care insurance in the market. Number one, it's gotten very pricey. It's gotten very pricey. I always use, if I had to say something about that, is it because I think one of the reasons is because there are fewer companies. I want to also mention that the federal long-term care insurance program, yes, has been around since 2002. But back in in December 2022, the federal long-term insurance put out an announcement that they are not accepting any new applications for the program. They need to reevaluate their whole program in terms of premium structure, things like that. So for the next 2 years, from December 2022 to December 2024, they said we're not accepting any new applications, nor can existing policyholders increase their benefits. You can drop your policy, but you cannot increase your benefits because they needed to reevaluate the program to see how they can come up with an optimum premium structure. Well, come 2 years later, this in December 2024, a year ago, 2024, they put another announcement out. We're not ready yet. We're going to extend it to another 2 years. So the federal long-term insurance program is not available to new applicants until later this year, December 2026. So in the meantime, I'd like to present some possible alternatives when it comes to long-term care insurance. And let's start off about this idea of self-insuring. Is it a good idea? I think it is a good idea for the following reasons. That when you buy a long-term care insurance policy, like any insurance, what's the whole idea? What's the whole idea of insurance in general? It's transfer of risk. You're paying a relatively small amount of money to protect yourself against a financial catastrophe, like being in a nursing home for 10 years, wiping you out financially. But with these increasing costs of long-term care insurance, it may not be worth it. If you could come up with something that is an alternative. Like I said earlier, when you buy a long-term care insurance policy, as long as you don't get the benefits, you got to pay the premiums. Once you do have a need for long-term care, the benefits will be paid out to you. Stop paying the premiums. Suppose you never get to that point where you need long-term care. You die. All those premiums you paid are gone. The insurance company keeps them. When it comes to self-insuring, you're going to set aside money somehow, some way. And we'll go through some of those ways here in a moment. Okay? This is your money. You use it. You need to use it. Fine. For long-term care, fine. But if you die, you die. That money you set aside. This is your money. You may set aside in a brokerage account that you have with your spouse. You die, what happens to the money? It goes to your spouse. You set aside part of your TSP, your IRAs, to use for long-term care. We'll get into more details here in a moment how that works. Okay? You set mentally, this part of my Roth TSP, Roth IRA account is going to be for possible long-term care. Suppose you do that and you die. What happens to your Roth TSP account? It goes to your designated beneficiary. What happens to your Roth IRA? It goes to a designated beneficiary. This is your money. So let's get into the specifics here. What I'm talking about, the Roth TSP. Yes, the TSP is a sizable chunk of money out there. Many employees, retirees have sizable chunks of money. I think the latest count, I think there's close to 200,000 TSP account holders worldwide who have over $1 million in their TSP accounts. Here's the problem when it comes to using the traditional TSP. When you take money out of the traditional TSP, it's all taxable. If you had $1 million in your in your traditional TSP accounts, and you want to set aside $500,000 for possible long-term care, that's for you. Maybe the other $500,000 will be for your spouse. And you know that somewhere down the line, that money's going to be needed to pay for long-term care. Well, when you take it out to pay for your long-term care or your spouse's long-term care, you got to pay tax, federal and state. So let's say it's costing $100,000 a year to be in a nursing home. You are in a federal, you have a federal marginal tax bracket of, 24%, state 8%. To take out $100,000, you got to pay $32,000 worth of taxes. That only leaves you with $68,000. So what I'm saying is, you got to think tax. And by the way, taking out $100,000 could push you from a 24% tax bracket to a 32% tax bracket. Whereas the Roth TSP, everything is coming out tax-free. Everything is coming out tax-free. The Roth TSP has gotten more attractive. One of the reasons the Roth TSP is more attractive is, unlike the traditional TSP, the Roth TSP is not subject to required minimum distributions. No RMD from the Roth TSP. You can keep it there indefinitely. Same thing with Roth IRAs. No RMD. No RMDs. I want to share a story with you in terms of using your federal retirement to pay for long-term care. This is a true story. I had a client, it was about 10 years ago. He came to me, I did his taxes, and then he wanted me to evaluate his whole overall retirement. He was about to retire. He was the old system, CSRS, huge CSRS annuity. I'm talking about, this was 10 years ago, like $150,000 a year, CSRS annuity. He put money into the TSP. I think he had close to $500,000 in the TSP. It was all traditional. The Roth had not really gotten started yet. But he had money in Roth IRAs. He had about $100,000 in Roth IRAs. So I went through everything. I said, looks like you got health insurance. You got a nice sizable retirement. I said, what about the missus? Well, she works for a private company. She has a huge amount of money in her 401k. She also is getting Social Security. I'm not. I said, the only thing I can recommend is buying long-term care insurance. He said, I'm not interested. I said, do you know the cost of long-term care? Oh, I'm well aware of it. I am well aware of it. But we made a decision that we are going to self-insure for possible long-term care. I said, you have a family? Yeah, 3 adult children, all in good shape financially. And we made a decision, our children are to get nothing of our retirement. We're not going to give them anything. We're going to use our retirement savings to pay for possible long-term care. I couldn't argue with him. I couldn't argue with him. He did his homework. The only thing I just had reservations about is using that traditional TSB. Was just a TSB. So money coming out is tax-free, and I've done that myself. Turned out that the long-term care insurance, the federal long-term insurance we had, was getting more expensive. The way it works with the long-term insurance is every 7 years, they will raise your premiums unless you do things to limit some of your benefits. One of the things I did in 2016 is that when they said they're going to almost double my premiums, I said to them, what can I do to make sure my premiums are the same? They said, get rid of your inflation. Your inflation factor, I think it was 2%, is driving up the costs. If you get rid of inflation, we'll keep your premiums the same. And from that point, I started investing in Roth IRAs to the point now that I have close to $200,000 in Roth IRAs. That if I had to go to a nursing home, I have 5 years of benefits and now $200,000 of Roth IRAs. What are some other ways of purchasing self-insuring for long-term insurance? They include annuities with long-term care riders, hybrid life and long-term care insurance, home equity conversion mortgages, and Medicaid. Let's talk about this. Okay, so I have a discussion here about different types of annuities, and then we're going to go to the other categories here. Let's do the first one, annuities with long-term care riders. Annuities are yet another alternative to standalone long-term care insurance policies. These products can provide a guaranteed income stream throughout retirement in exchange for an upfront payment. As with permanent life insurance, annuities can be combined with a long-term care rider in order to cover qualifying long-term care expenses. These are often called long-term care annuities. According to the Administration for Community Living, ACL, there are two main types of long-term care annuities, immediate and deferred. Immediate long-term care annuities provide a fixed monthly income for a life or for a set period in return for an upfront premium payment. This option is available to applicants regardless of their health, even if they already require long-term care services. The monthly payment amount will depend on the annuitant's age, health, and initial premium amount. Deferred long-term care annuities. Deferred long-term care annuities are available to applicants up to age 65 who can meet certain health criteria like immediate annuities. You can make a single premium payment and receive a fixed monthly income stream for a specified period. Okay. Hybrid life and long-term care insurance. Another alternative to traditional long-term care policies are hybrid life and long-term care insurance plans, which many of the best long-term care insurance companies offer. Hybrid policies are generally life insurance policies with built-in long-term care benefits. Many insurance companies offer also long-term care insurance riders as add-on to their life insurance products. Hybrid policies include a death benefit payable to your beneficiaries when you die. If you need long-term care, you can access a portion of the policy's death benefits to pay for the expenses, and your beneficiaries will receive a reduced amount. If you don't need to use long-term portion of the policy, your family gets the full death benefit. What that means is, one of these complaints I get all the time about buying long-term care insurance, gee, I paid all those premiums, and if I die before I ever get to go to a nursing home or need long-term care, I lost all my premiums. Well, in this case here, you won't. Your beneficiary, your designated beneficiary, will get the life insurance equivalent, a tax-free death benefit in the form of life insurance proceeds. To be eligible for long-term care funding through a hybrid policy or FLTCIP provider, a qualified health provider must diagnose you with a chronic illness. You may consider You may be considered chronically ill if you have a severe cognitive impairment or can't complete activities of daily living such as bathing, toileting, dressing, and eating without assistance. Hybrid policies tend to be more expensive than their standalone components, and you may not need life insurance if you don't have anyone who depends on you financially. That's the problem. I want to mention also that with the insurance companies that offer these, some of the insurance companies that offer these hybrid policies, I've noticed that in order to get this policy going, you have to contribute a minimum $100,000 of cash proceeds to get the policy going. Because these hybrid policies are not term policies. They're cash value policies. They build up earnings that are added to the death benefit. To get the policy started, the insurance company wants you to input $100,000. That's a lot of money, and you cannot make a direct rollover of money from your TSP into these policies. You'd have to ask for a distribution from your TSP. Traditionally, you have to pay tax and then use that money to put into this policy. So they definitely have a downside. Another way of paying for self-insuring for long-term care, these home equity conversion mortgages. A home equity conversion mortgage, HECM, is a type of reverse mortgage insured by the Federal Housing Administration. The program lets you borrow a portion of the equity of your home, which you can use for any purpose. The loan amount you may qualify will depend on your age, the value of the home, and the current interest rates. To qualify for a HECM, you must be at least 62 years old, have a small mortgage balance or own the house outright, and live in the property as your principal residence. Other borrower eligibility and property requirements apply. According to the Consumer Financial Protection Bureau, the loan must be repaid once the borrower dies, sells the home, or the home is no longer their principal residence. That may pose a problem for single borrowers who plan to use the loan proceeds to cover their stay in a nursing home or assisted living facility. How about if they're married and they have to go to a nursing home and they have a spouse living in the house? That means the spouse is going to lose the house. And I've seen horror stories about that. If the borrower lived in a facility for 12 consecutive months and there was no co-borrower or occupying the property, the loan would become payable. That's what I'm talking about here. I've seen where surviving spouses have had to sell their home, in some cases at a loss, and because they can't afford to pay off the loan. And finally, Medicaid. Medicaid, the government-funded health insurance program, pays for some long-term care services, including those provided in nursing homes. However, there are strict limits on the amount of income and assets you can have to be eligible for Medicaid, and these vary by state and family size. For many, paying out of pocket for long-term care for several months will reduce their savings to enough that they will qualify for Medicaid. But no one wants to burn through their savings to pay for care. And for married couples, this could leave the healthy spouse destitute. Giving away or transferring your assets for less than they're worth to become eligible for Medicaid can automatically disqualify you from receiving benefits, like you give gifts to your children, grandchildren. There's a look-back rule of 5 years. Medicaid, they're going to look back. The Medicaid's going to look back 5 years to see what you have gifted out of your estate in order to qualify for Medicaid. But some strategies like retitling assets, investing in specific annuities, or setting up a qualified income trust can lower your recognized income and assets without disqualifying you for Medicaid. Since the laws surrounding this issue are complex, it's best to consult with a knowledgeable attorney or financial planner in the state that you live in. That's only part of the bad news for Medicaid, in my opinion. The other bad part of the news Medicaid is you have no choice. When you want to use Medicaid as a means to pay for your long-term care, number one, you have to be almost impoverished, and every state has its rules about what is considered to be impoverished. I believe I live here in Maryland. I think in Maryland, you have to be down to no more than $2,000 in terms of your savings You can keep your life insurance policy. You can keep your car, and any income you're getting, like Social Security or the federal pension that's coming in, the state's going to take that in order to qualify for Medicaid. But here's the other problem. You have no choice. You have no choice. You have to go to a nursing home, a Medicaid facility. You can't go to an assisted living facility. There are some very nice assisted living facilities out there. You can't be treated at home. I would dare say most people, if they had a choice, would rather be in the comfort of their home, having home health care, having to pay for home health care rather than going to a nursing home. Well, these Medicaid facilities, some of them are god-awful. A couple of years ago, when HHS was very, very determined to make sure that the nursing homes were, this is pre-COVID, were doing what they were supposed to do in terms of taking care of the people, the residents there, HHS would do audits of the home. They come into the home to see what it looked like, the quality of services. And one of the things they did was, this is HHS, they would go into rooms, visit the residents there in the room, and count bed sores. And the facility that had the lowest average number of bed sores was considered to be the best Medicaid facility. That is pretty sad. And now, since COVID did a whammy on nursing homes in general, but especially the Medicaid facilities, because they can't get the help. The pay is miserable. And many of the people who would normally work in these Medicaid facilities found better jobs. They're gone. So this has really resulted in the deterioration of these Medicaid facilities. So it's not the way to go. That's the point I wanted to make. All right. So let's talk a little more about recent developments in the long-term care insurance market. General considerations and observations. Long-term care costs present a substantial financial risk to individuals and their families. Medicaid, pays for various things, mainly help them pay for health insurance for the impoverished, but also for long-term care for people who cannot afford long-term care insurance. And that part of Medicaid is the one that's faster growing. Meanwhile, Medicaid has been cut back like everything else when it comes to, spending. More and more private insurance companies are dropping out of the individual long-term care insurance market, like I said earlier. There's about 5 to 10 insurance companies, probably it's closer to 6 now, offering individual long-term care insurance policies during 2025. That's a reduction from 80 to 100 back in the 1980s. Those remaining individual insurance companies in the long-term care insurance market are increasing premiums to new and existing policyholders by as much as 50 to 100%. It's gotten so bad that those individuals who bought private individual long-term insurance policies, let's say in the 90s to 2000s, even early 2010, their costs have gone up 50%. They said they can't afford it anymore. They can't afford the premiums. So they've dropped the policies. Now, those individuals who have a net worth of $2 million or more, excluding the equity they have in their homes, probably want to forego applying for long-term care insurance, especially if they're getting close to 55. They may want to forego applying for long-term insurance and instead do this self-insure thing for possible future long-term needs. And my recommendation is, if you're a federal employee, federal retiree, do use that Roth TSP. Roth TSP. Keep in mind, the Roth TSP has been around ever since 2013, and many federal employees have taken advantage of it. Starting this month, like yesterday, January the 27th, the TSP does allow individuals, TSP employees and retirees, to convert their traditional TSP to the raw TSP. Downside is you got to pay the tax. Now, I'm not going to say any more about that. It's not for everyone. If you want to know more information about this conversion of the traditional TSP to raw TSP, please attend one of our monthly TSP webinars. We go in more detail about that. But to me, that is well worth it. Also, for those of you who are employees and over age 50, keep in mind that under a law that took effect this past month, January 1st, 2026, any catch-up contributions you make have to go to the Roth TSP account. That is, if your Social Security wages in the previous year, this is the case 2025, were over $150,000. They have to go to the Roth TSP. You can put all your money to Roth TSP, but for some individuals, that's not a good idea, because keep in mind that the Roth TSP, using after-tax dollars to contribute to it, whereas the traditional TSP uses pre-tax dollars. Before you do any of this, converting Roth TSP, traditional TSP to Roth TSP, putting more money into the Roth TSP via contributions, please talk to a qualified advisor, especially a tax advisor. You can talk about this more as part of your Part 2 meeting, okay? Several individual insurance companies are combining life insurance and long-term insurance in one policy. It's expensive insurance. I mentioned about you have to roll in some cases almost a minimum of $100,000 of cash before you get this life insurance policy, which is a cash value policy to start building up earnings. Also keep in mind, you're talking about two animals here. The insurance companies, when they offer these hybrid policies, they have to when they do the underwriting, they're doing the life insurance underwriting part of it, and then there's the long-term care insurance underwriting in order to come up with an optimum premium. That is the best premium. That premium undoubtedly is going to be higher. Many individual annuities offer riders in which a portion of the annuity may be withdrawn penalty-free to pay for long-term care. I advise you, if you're going to buy this annuities, be very careful. Annuities, unfortunately, many times annuities are sold, they're not bought. People don't know what they're getting themselves into. You have to be well-versed to know what's involved with, and how this annuity works. I would talk to a competent advisor. You can bring it up during a Part 2 meeting. The people serving those who serve are well-versed. They're all insurance. They all have licenses in insurance. They can answer your questions about different types of policies, different types of life insurance policies, different types of annuities. But be careful. Watch the fees. Besides fewer insurance companies offering long-term insurance, as well as steep increases in long-term care insurance premiums, the COVID epidemic has affected the long-term care insurance market in several ways. One, nursing homes, assisted living facilities were severely affected by COVID, affecting residents and staff. Two, individuals are fearful of entering long-term care facilities with the fear of COVID outbreaks and short staff shortages. There's a hesitancy now of going into nursing homes. Even home health care has been affected by COVID in the sense that home health care aides are reluctant to enter private homes. It's some of this stuff is carried over. COVID's been gone now for a couple of years, but still some of the effects are still being felt. For the federal long-term care insurance program, if you want information, please go. There's the on the OPM website, or you can go to www.ftcfeds.com. The information about the program. It's run by the Long-Term Care Partners, LLC. That's John Hancock Life and Health Insurance Company. But I want to bring up the fact that I mentioned a few moments ago in terms of the program is not open now for new applicants. If you do have the federal long-term care insurance now, you keep it. You have to keep paying the premiums, whether you're an employee or retiree. If you do not have it and you're interested in getting it, you're going to have to wait until at least December 19, 2026. Once it does open up, the federal long-term insurance, who is eligible to apply for it? Employees and spouses. If you have children over the age of 18, any child can apply for it. If you have living in-laws, you have living step-parents, living parents-in-law. They can apply for it based on the fact that you're an employee. If you are a retiree, you can apply for it. So can your spouse. But if you have parents, in-laws, they cannot apply for it. Only parents of employees and in-laws, parents, step-parents, in-laws, step-in-laws of employees can apply for long insurance. This is not a group health insurance program. Everybody has to apply on his or her own and has to qualify on his own. There's underwriting. This is not guaranteed issue. This is not like the federal employee group life insurance or health insurance, which are guaranteed issue. You have to qualify for it. They're going to do underwriting. They're going to ask you questions. They're going to look at your medical records. Again, they may come out to your house. If you're, over 65, you want to see, where you live, you miss your house. Here's again what the federal long-term insurance has to offer. Okay. The federal long-term insurance program is sponsored and regulated by OPM and supported by the strength and stability of John Hancock Life and Health Insurance Company. The program was established in 2002 as a result of an act of Congress, the Long-Term Care Security Act of 2000. For detailed information on this feature, here is the latest version. It's called a Federal Long-Term Insurance Program, FLTC 3.0. It started off, I think, at 1.0. Now we're up to 3.0. And here's what's included as part of comprehensive coverage. Choice of care. Long-term care can be provided, they'll pay for long-term care provided at a nursing home, an assisted living facility, a hospice facility, an adult daycare center, or at home is covered up to 100% of your daily benefit, your DBA, 100%. Whatever you choose for your DBA, you get reimbursed for no matter you are in this, this type of setting. Friends and family caregivers. Care provided at home by informal caregivers such as friends, family members, and other unlicensed caregivers is covered by up to 100% of your daily benefit amount as long as your caregiver isn't your spouse or domestic partner and didn't live with you when you became eligible for benefits. When informal care is provided by family members, it's covered for up to 500 days of care in your lifetime. And here's something important. International benefits. Care received outside the United States is covered up to 100% of your daily benefit amount. If you plan to move overseas, Europe, South America, wherever, it's nice to know that this policy goes with you. I don't know of any individual life insurance company that offers a long-term care insurance, individual policies that has. This is a big benefit. International benefits, because it may be the long-term care overseas is better quality than it is in this country. The countries like Europe, Germany, Britain, France, Switzerland, they're much more up to providing long-term care to their residents. They can afford it more. They don't have such a huge amount of people. So it's nice to know that that's available. There's a stay-at-home benefit. Options that help support care at home including care planning visits, home modifications such as installing wheelchair ramps. This is all part of the policy of federal long-term insurance. Emergency medical response systems, durable medical equipment such as walkers, hospital-style beds, and home safety checks are covered up to 30 times your daily benefit amount. Caregiver training is also part of the stay-at-home benefit, but only covered up to 7 times your daily benefit amount in your lifetime. This benefit can be used at any time once you're eligible for benefits, including during the elimination period. Alternative plan of care, in certain circumstances, customized benefits for services that are not specifically covered by the federal insurance will be considered if they meet your needs and are most cost-effective. Other things here. Okay, the federal long-term insurance is guaranteed renewable, meaning your coverage will not be canceled as long as you pay your premiums on time, and your coverage can't be canceled due to your age or a change in your health. Waiver of premium. Once you completed your waiting period, you do not have to pay premiums while you are receiving benefits. Portable coverage. Even if you're no longer a member of an eligible group, for example, if you're an employee who leaves federal government, if you leave federal service, you own this long-term care insurance policy offered by the federal government, and let's say you get RIFT or there's a discontinued service retirement, you're forced to leave federal service, you take your policy with you. Now, the premiums you pay for your federal long-term insurance, if you're an employee, they're deducted from your paycheck. If you're a retiree, they are deducted from your annuity check. If you leave federal service, you're not getting a paycheck, you're not getting an annuity check. You have to make arrangements then with the federal long-term care insurance partners to have your premiums deducted from a checking account or a savings account, okay? And here are some more things here. The benefits are designed to meet your needs. OPM has worked closely with John Hancock to ensure the insurance coverage offers the kind of benefits and features that are valuable to members of the federal family today and the future. You'll find that with this program, you can choose to receive care at home, in a assisted facility, and nursing home. Yeah. And so on. All right. So federal and U.S. Postal Service employees, active and retired members in uniformed services, and their qualified relatives are eligible to apply for coverage under the federal long-term insurance program. Specifically, persons of defined groups are eligible for coverage. Here are the employees and annuitants. Also, members of Congress are eligible to the program. The premiums that you pay for your long-term insurance policy, you're paying 100% of the premiums. The federal government contributes nothing. Nothing. It'll be very interesting to see what happens this coming December 19th, 2020, when the program opens up. What is going to happen? They shut down the program to come up with an optimal way to attract more people, to attract more employees and retirees, to come up with an optimal way in terms of the premiums. Because the federal government has learned the hard way that this program started in 2002, they were not attracting enough employees. So they promised they would come up with a way to make it more attractive. It will not be with cheaper premiums, I assure you. They're going to have to do something to make it more attractive. Here, this comes off their website. Why the federal long-term insurance? OPM has worked closely with John Hancock to ensure the insurance companies on this program offers the kind of benefits and features that are most valuable to members of the family. Choice of care, consumer protections, international benefits, home care, friends and family, and benefits for family. I will tell you though, and I've gotten this question many times. Ed, I got the federal long-term care insurance. Premiums goes up. It seems like the premiums go up every 7 years. It's getting to the point now I can't afford it. Should I drop it? You can drop it any time you want. You don't have to wait until the program is opened up again or an open season. You can drop it anytime you want. I advise you not to do that though. Because I will tell you that if you drop it, you're not going to get any money back. You lost it. It's like dropping any insurance policy. During the last open season, they have open seasons roughly every 7 years. That was in 2023. They had one in 2016. One of the options was that if you could not feel you don't want the policy anymore, you can't afford the premiums, we will give you a lump sum payment, And I saw what the lump sum payment was in my case and my wife's case. All it was is they're going to refund you all the premiums you paid since you made your first premium payment. In my case, it was like $21,000. That's what going to give you. They're taking the premiums you paid and giving them back to you. No interest, no nothing. It's a joke. It's an absolute joke. Now, that was during the open season. If you drop your policy, your FLTCIP, Federal Long-Term Insurance Policy, now or later, you won't get any money back. But don't do that. And if you say, well, I'll try the private market. The private market is not much better. They've increased their premiums for people really, earn a fixed income, Social Security checks. They can't afford it. They have to drop their policies. All right, Dan, I have come to the end here. So let's wrap this up and take it, and then we'll take it from there.
Yes, sir. Folks, working with that as long as I have, I know what it feels like when you're drinking from that fire hose of information. So one of the biggest things we do in part 2 is help you process all of that. So I just want to take a quick moment to reiterate the difference between part one and part two. So for example, say with TSP, regarding part one, what are the rules? How much can you put in? How does the match work? Regarding part two, how might you be maximizing your TSP? What's a good strategy for you? Regarding your pension, part one, how does the pension work? What's the eligibility criteria? Part two is what is yours going to look like? And what does it look like if you work a little longer or even a little shorter? Regarding Social Security, part one is what are the rules around when you can draw? Part two, what might be the best strategy for you and your family as far as when to draw? So on the screen, you can see another one of our QR codes to schedule your part two session, or again, you could just email us at part2@swserve.com. We created this on-demand format because you asked for flexible training that fits your schedule. And that's what we try and do here at Serving Those Who Serve. We listen to what federal employees need, and we do our best to respond. That's where the mission comes in: reach, teach, and serve. So whether you're just starting to think about retirement or getting close to making a decision about it, we're here to help you understand your benefits and make informed choices. If you or you know somebody who's being pressed to make a decision at work, we had a whole lot of that last year. It was terrible. Pass them along to us. Thank you, Ed, for another comprehensive training session. And thank you for taking all the time that you do to invest in federal benefits education. Folks, thank you for joining us. Check out our website, swserve.com, for more on-demand trainings, Ed Fed Zone columns, the FedLife podcasts, and other valuable resources for federal employees. And remember, this training is available to you to watch anytime you want. If you need a refresher, it's not going to go away. And when you're ready for personalized guidance, we're here for part two. So thank you for being part of the federal employee community we serve. Ed, why don't you give us the last word?
Thanks, Dan. I want to thank everyone for attending and for listening to the broadcast, and look forward to talking to you with other live webinars. There are other topics you are going to be recorded. You can listen to us too, but whatever it is, please take advantage of everything that's out there. The webinars, ask your questions, blogs, podcasts, everything's out there. We're here to help you. That's why we're called Serving Those Who Serve. So please take advantage of what's out there. We're the only firm in the country that does this. Trust us. So wish you all the best. Be well, stay safe. Wish you all the best in your future endeavors. And finally, I want to thank you, Dan, for hosting today. I couldn't do this without your full support, so thank you.
Always a pleasure, my friend. Folks, we'll see you next time.